In this video, I'm going to go over the accounting equation and I'm going to show you how some example scenarios will affect the equation. Hopefully you watched my previous video where I explained the whole equation. If not, I would suggest watching that video first and then coming back here. The basic accounting equation is assets equals liabilities plus equity. Anytime a transaction happens, it's going to affect this equation. And this equation should stay in balance after every transaction that affects it. So what I'm going to do is walk through these example situations and show you how they would affect this equation. And what I did was create columns for the different assets that are going to be in this example: cash, office furniture, and equipment. And then over here, I have just accounts payable under liabilities and the owner's capital account under equity. Now, if you remember, the expanded equation was assets equals liabilities plus equity. And I had said that on the equity side, that's going to consist of 4 different types of transactions: owner investments, where the owner puts money into the business, minus owner draws, plus any revenues that the business earns from selling products and services, minus any expenses that happen that they have to pay to run their business. To save space, I'm going to put these 4 different types of transactions in this column. And then over here on the right, I have a column to just type in the type of equity transaction. I'm only going to do that when something affects this column, this capital column. Okay, so let's get started. This business is a consulting firm called Williams Consulting, opened by the owner, Sandra Williams. And these are transactions during August, the first month of operations. The first thing that happens is the owner invests $30,000 of personal funds to start the business and deposits that money into the business checking account. Now, it says cash here, but we're going to just use that as meaning the checking account. And the reason I'm doing that is because a lot of books will have that. They'll just say cash, when in real life it's usually a checking account, because who keeps $30,000 in cash in their office? However, I'm just trying to keep this in line with different books that you might be learning out of. So what we have to do is look at this transaction and figure out what it affects. Now remember, accounting is a double entry system. So if you add or subtract to one account, you also have to add or subtract to another account in order for this equation to equal. So if she's investing $30,000 of personal funds to start the business, that is going to be an owner investment. That's going to add to capital. So I'm going to put a $30,000 amount over here in this capital column. And because it's a capital transaction and there's 4 different types that go in here, I'm going to put over here what type it was. Okay, and then not only does this affect the owner's capital, because it's an owner investment, it also affects the cash of the business. The business now has $30,000 of cash to start purchasing things and paying for things. So I'm going to add $30,000 on the left side of the equation under assets, and I'm adding $30,000 to the right side of the equation as equity. So if I were to calculate the ending balances right now to make sure this equals, I have $30,000 under cash, $30,000 under capital. The left side of the equation equals the right side of the equation. And that's it. And then in the next one, an office was located and rent of $1,500 was paid for the first month. So first of all, if they paid for something, it doesn't say paid cash or paid with checking, but I'm just going to have to assume that because it says was paid. So that's going to subtract from cash. Now in accounting, a lot of times you'll see parentheses around negative numbers, And that's just to basically set it apart and make it easier visually to see that that's a negative. If I were to just put a tiny little minus sign in front of it, and I had a big spreadsheet full of numbers, it's going to be a lot harder to see that. Whereas if I put parentheses, it's a lot easier to visually see that that's a negative. So I'm putting parentheses there. That's going to subtract from cash, and I could calculate the new balance, which is going to be 30,000 minus 1,500 equals 28,500. And then that transaction was also rent expense. It's an expense of the business. We're assuming that they're paying for the current month. If they were paying for future months, it might be prepaid rent, which is an asset. But if you were given this worksheet in a class and you had these columns here, you could see that prepaid rent is not there. And it doesn't give any details that say that anyway, so we're just going to assume it's for the current month. It's the beginning of August, and they're paying for the first month. They just opened the business. It's the beginning of the month. We're going to assume that's for August. So this is rent expense. And remember, expenses subtract from equity. So we're going to have a negative 1,500 over here under the capital column. And I'm going to write rent expense over here on the right. So now I'm going to calculate the new balance in this row right here. 30,000 minus 1,500 is 28,500. So both sides of the equation, the left and the right, still equal. Okay, then in the next transaction, they purchased office furniture for $5,000. Now notice it has the words on account here. When you see on account in an accounting book, it's usually referring to accounts receivable or accounts payable. So it's just terminology that you may see. In this situation, they're purchasing something, so I'm going to assume that they owe money for it, and that's an accounts payable. So in this situation, we're adding to the debt of the business. So that's going to be a positive number under accounts payable. And then at the same time, they're purchasing furniture. That's an asset. So I'm also going to add 5,000 under office furniture to show that the business just increased the amount of furniture they have in their business. They just added an asset to their business. Okay, now I'm going to go ahead and calculate the balances. Cash didn't change. I'm just going to bring this 28,500 down. I now have 5,000 under furniture, still nothing in equipment, 5,000 in accounts payable, and 28,500 under capital. So once I calculate the balances, if I were to add up 28,500 and 5,000, that would be 33,500. And I would get the same thing on the right side of the equation. It's the same numbers on both sides. Then in the next transaction, a computer and other office equipment were purchased on account. Again, here's the on account terminology. It's a purchase, so we're likely dealing again with accounts payable. This time it was 2,500, and this time it was equipment. Okay, so on this line for August 9th, I'm going to put 2,500 under equipment and 2,500 under accounts payable. So I just added 2,500 to both sides of the equation. Okay, and then I would get the balances after that on this line. Nothing has changed with cash, so I'm just going to bring down that 28,500. Nothing's changed with furniture. I'm just going to bring down the 5,000. Now they have 2,500 in equipment. So if I were to add up the left side of the equation, I would get 36,000 if I added these three numbers. And then on the right side of the equation, I already had 5,000 under accounts payable, and then I just added additional debt of 2,500. So that's going to be 7,500 total. And then of course I would just bring down the capital balance of 28,500. And if I were to add these two numbers on the right, I would get 36,000 as the total on the right side of the equation. So the left and the right side of the equation still equal at this point. Okay, then in the next transaction, they paid 3,000 on account. So they're making a payment towards this accounts payable. You know they're dealing with accounts payable because if it had been accounts receivable, they would be receiving money, or they would be dealing with customer sales or something along those lines. But all this says is they paid, which means it's coming from cash. So it would be a subtraction from cash. And then on account just means they're paying towards this accounts payable. So I'm going to go ahead and put a negative 3,000 here. So under accounts payable, under any liabilities, when you borrow money, you're adding to debt, but when you make a payment, you're subtracting from debt. So that's going to be a minus. And then it's subtracted from cash, of course, because it was money they paid out. It took away from the cash of the business. And then now I'm going to look at the balances after that. For cash, if I take 28,500 minus 3,000, that gives me 25,500. Nothing changed with furniture, so I'm going to just bring that balance down. Nothing changed with equipment, so I'm just going to bring that balance down. For accounts payable, they owed 7,500. They paid towards that. They paid 3,000. So now the balance over here is 4,500. And then of course, capital hasn't changed. So notice when they made a payment, it did not affect the asset accounts themselves. It didn't affect the furniture or the equipment account. It only affected the debt and the cash of the business. You already recorded the purchase of the furniture and the purchase of the equipment at this point. So all you're doing is showing that they're making a payment towards the debt. For the next example, it says during the rest of the month, Sandra performed consulting services and earned service revenue of $6,000, receiving cash. So we have two things being affected here. The business earned revenue and they received cash at the same time, and it was $6,000. So first of all, that's going to affect cash. We're going to add that to cash in the cash column. And then that's revenue that they earned, which adds to equity. So over here under the capital column, I'm going to add 6,000 here. And then over here on the right, because it's an equity transaction, I'm going to just put in here what type of transaction that was. And then I would calculate the new balances after that situation. So 25,500 plus 6,000 is 31,500. Nothing changed with furniture, nothing changed with equipment, and nothing changed with accounts payable. So for those three things, I'm just bringing the number down. For capital, I'm going to add the 28,500 and the 6,000, and I get 34,500. And if you were to add up the numbers on the left side of the equation, you should get the same number as what you add up on the right side of the equation. So I'm just going to add that up real quick. If you were to add these numbers, you would get 39,000. And if you were to add these numbers on the left side of the equation, you would also get 39,000. Okay, and then the last transaction is the owner withdrew $1,000 from the business for personal use. That's going to be an owner draw. That's going to subtract from equity. And that's also going to subtract from the business's cash because she's taking money away from the business. So under cash, you would have a negative 1,000. And then under equity, because this subtracts, you would have a negative 1,000 over here as well. And then I'm going to put over here owner withdrawal. And then I would want to calculate the new balances. So for cash, I would take 31,500 minus 1,000. and I get 30,500. Office furniture hasn't changed, equipment hasn't changed, and accounts payable hasn't changed. And then for capital, I would take 34,500 minus 1,000 to get 33,500. And that's it. You would then want to add up the numbers at the bottom. So there's an extra 0 there. And then you would want to add up the numbers on the bottom, add up the numbers on the left, and you should get 38,000 for that. Let me see if I can put this in the middle. And then you would also want to add up the numbers on the right, and you should get the same number. So basically, this side of the equation adds up to 38,000, and this side of the equation adds up to 38,000, so the accounting equation is in balance. And that's all you have to do. For every transaction, I simply looked at what accounts were affected, and then after that, I got the new balance and made sure both sides equaled. And that's all I wanted to cover today. If you have any questions, please let me know in the comments, and thank you for watching.